really bad news. But of course, I am here to discuss. Hopefully, in just less than an hour, I'll be fast on this. Title is very simple. We do expect lower stock prices over the next 6 months. That means we remain short on rallies. We would remain buying dips only on commodities and probably some food security providers, sometimes solar companies to address the oil crisis, but definitely less on the longs, more on the shorts. So let's discuss the charts. For those who are looking to buy, what if I told you or we told you that you can save 25% more just by waiting it out? You don't need to do anything. You don't need to short. You don't need to buy, but wait it out in cash. We do think that the volatility remains high and markets remain agitated. We would see more sell-offs around the uncertain trajectory of this war. Even if you get negotiations, as long as there remains a lot of dead bodies, as long as there's firing, and to be honest, I don't know if my headache comes from all the deaths that I'm seeing online, which is happening in Ukraine war. I'm not quite sure where I'm getting this headache. Either way, I do believe that the geopolitical climate and the world changing orders are enough to remain very agitated for a long while, which means that there will be no capitulation, if any, for people to be bullish. Any rallies, as we've seen this week, has just been met with more sell-offs, and it is not sustainable. So let's just go to the charts here. We think that there remains still plenty of put options for you to initiate or just simply to short the shares. Cheesecake Factory, which is a consumer discretionary name, will of course be affected by less people dining out and higher inflation. Chipotle, which released a new chicken limited menu, is seen as a good news by people, and it is actually seen for us to be a chance to sell it off. At 1,500 or 1,600, a put option would be entertained for the next 3 months. Now, as a lot of countries are easing their restrictions, we do have to say that Airbnb and Six Flags, sometimes Disney theme parks would rise. We would view any 10% pop on these stocks to be a sell-off. So these are just price levels for you to take a look at. Airbnb around 160. It's currently trading at 150. So that means we're still waiting for a recent, another high to happen, possibly because of good news. I think some people are saying that a lot of people are booking on Airbnb, especially in Ukraine, to help support the country. That means that a lot of people are actually seeing Airbnb as a donation tab. But how many people in the world will actually donate towards Airbnb just to help Ukraine, the host of Ukraine, basically? What I'm saying is that the true demand is probably going down, and all of these are one-off indications. And with inflation looming worldwide, we do think that Airbnb and Six Flags, Cheesecake Factory, Chipotle, these represent consumer discretionary items, will continue to get pummeled as the months go by. So this is Cheesecake Factory. It has been falling down. We note the breakdown of support at $45, and this breakdown spans over 7 years. And we think that this breakdown of 45 will continue going down to 35, 30, 25, 20, 15. Will it break all the way down to the lows of pandemic? It is unforeseeable. I don't know if it will. But with a super commodity bubble, chances are it's gonna either go down to retest that 15, or at the very least just follow a downtrend channel where it is a hard recovery for most of these restaurants. So a price here of 35, any rally near 40 or 45, we would view Cheesecake Factory as a sell. Chipotle hasn't broken down. You'll see that 1.3 has been supported for quite a few years now. However, we see actually this is still at near all-time highs. Despite the fact that Chipotle has broken down this 1.7 area, we think that it has been trading in the range from 1.3 to 1.7, brought about by very good earnings and the confidence of the company to pass on the cost to the consumers. At some point, we think that those are limited in nature, and the consumer will have to bite some of those costs. And at some point, it actually will slow the demand. So Chipotle here at about 1617. As it goes up in price, we are contrarians, or actually we're not contrarian. We're just following the trend. As you can see, we're just following the trend in shorting what is obviously a consumer discretionary item that is going to suffer with high inflation. So this is your crude oil. We see that there is strong demand here at $95. Initially, this was just really all about the reopening, as people were very confident that there will be ease of restrictions and people can travel again. Therefore, crude oil is going to be in high demand. The world functions with 80% oil. And with this geopolitical event spurring to this super commodity spike from 95, it rallied straight to 130, which is a $40 move, something that has happened over the last 3 months versus 5 days. Obviously, this is just profit taking. It could even go down to 95. However, we believe that crude oil will stay above $90. And so any dips of oil is a buy zone for us, as any rallies near 115 to 125, while there are resistances, the trend remains your friend. However, this trend is a bad trend, wherein we see a super commodity move on the upside, sparking more inflation. Now we're looking at charts of Six Flags. Six Flags has barely recovered since the pandemic, and we could see that it is much more difficult to recover, just like all the cruise liners and the Norwegian lines, and as well as your jets. Basically, all airlines, including theme parks, are going to have a difficulty. With Six Flags trying to recover that 45 mark, the prior support is still a resistance for 2022. It's possibly a resistance for the rest of the year. So for the entire 12 months of the year, we expect 45 resistance for Six Flags. Any rally from $40 to 45 is seen as a chance to short. So for people who think that, oh, the markets are already down, there's no opportunity to short, we disagree. Consumer discretionary and reopening stocks have been bid up from those pandemic lows because there was a worldwide hope for recovery. However, that recovery could be dashed simply because of consumer spending, perhaps allocating more to the essentials rather than to discretionary items. And this is one of those victims. So one of the victims in our view of consumer inflation, consumer spending going down, inflation being above 8%, is Airbnb. So as the world is very confident on traveling after the pandemic, the spike on oil prices is gonna impact a lot of those spending. We view this rally towards 160 to 180 and 190 as a chance to sell. Take note as well, Airbnb trades at very high valuations. Actually, this is trading with more than 15 times price to sales. I believe that their sales is 6 billion. It's trading more than 90 to 100 billion today. So you can consider the fact that a company that's not earning money yet and still trading at very high price to sales comparative to the rest of the large caps and the technology space will have a ton of selling off. Because what's going to happen here has nothing to do with their guidance. They might actually guide very strongly. Their outlook might be very strongly, but that outlook could also be very murky given the situation in Europe, the recessions that's happening now in Europe, in Russia, and it will trickle down as well in Asia. So don't think that there is no trickle down effects of this worldwide war. Inflation is one thing, and there are very much skeletons to be uncovered on the banks, which we will begin to also read up upon. Okay, so semiconductor stocks were very confident in their outlook, and we would caution on that. We heard Lisa Su of AMD say that they were very confident in the passing on of the costs towards consumers. Well, semiconductors are really keys on your PCs, personal computers, communications infrastructure like 5G, automotives, cars, consumer products like iPhone. Over time, we think that all these materials are very expensive and it will kill demand everywhere. We do are pricing a recession in our base case. Therefore, semiconductors, which is considerably able to be shorted via success. So all you got to do is buy the inverse fund. We have been buying this since 380. And we think that a higher low at 450 is continuously a buy, which will give you, any entry at about 450 or 4 is a great entry point. That means that we are bearish on consensus favorites like Nvidia, AMD, Qualcomm. Yes, they've gone very strong earnings, but we disagree in the thinking that they would remain inflation resistant. So in this part, we are following the charts, but we are also seeing that the fundamentals are actually deteriorating despite all the outlook that commodity is a one-off. Actually, most of the it depends, depends on which research that you're reading upon. Some research reports houses are very fast in pricing in a recession. Others are even pricing in a stagflation. However, what we can see in the market is that not everyone has been pricing it in. If there is a true recession, how come semiconductors haven't fallen down 40-50%? We are still seeing Nvidia, AMD just trading 25% off of its highs, and it could actually fall 40-50% further from here, which means that there is still rampant price changes that could follow, especially on semiconductors. Now, also, we think that if the cars that you will be paying for could potentially be higher, will you? It could be $10,000 higher or $20,000 in the next few years if you are going to order. A lot of people on Reddit in surveys being asked, thousands actually answered that they would cancel an order if it was more expensive than they thought. So if it was a $50,000 electric car that they thought, and suddenly it's 60,000 or 70,000, a lot of people will actually renege on those orders and cancel it. So while we believe that there will be a dominant market share on Tesla, we believe the overall self-driving industry is in peril with all these high prices, basically. So with very expensive prices, we would argue that most of these electric vehicles are still in the infancy or more on the early stages. Therefore, a lot of it is being sold down, and we agree with the sell-off, and we actually agree it will continue to sell off furthermore, at least by 25% furthermore. So with more downside than upside, the risk reward continues to be favorable to the shorts. So iDrive, which owns a ton of Tesla, and as you've seen last night, a lot of Chinese cars were just getting dumped because of the listing announcements. It's possible that while there was no blatant news about NIO and XPeng, and the fact that NIO, XPeng, Li Auto are actually listed in Hong Kong anyway, but the point here is that I think the fact that Russia and China remain friends in this Ukraine-Russia war is seen as a sign of guilty via association. So we are actually seeing Chinese companies becoming a global pariah as well because of the affiliation with Russia. Because China remained neutral, and China it depends really on how you read about it. China is saying to be neutral, to be a peace-loving country, but there was no peace being seen out loud with the killings and with aggressive invasion in Ukraine. So the fact that China couldn't truly condemn and remain friends and still actually solid friends with Russia is we believe that there will be more trade war conflicts and sanctions. The world can actually turn the world cannot afford to turn itself away from China. From investment standpoint, I think investors are seeing that there is no reason to see an end in the bottom for China. There is no bottom when you see China following the suits of Russia. So autocratic regions are being priced, I think, lower and lower, perhaps to zero. This is why you see Alibaba victimized new lows. Hong Kong was down 9%. Let me explain to you what just happened in 2 days in Hong Kong. A lot of commentary about it here. So David Ingles of Bloomberg TV tweeted this. He has seen so many bad days, but to see a 9% down day on all the Hang Seng Chinese technology stocks tells you something. So last night, let me show to you just how big of a drop. So let's take a look at each one of the Chinese names here. So you're seeing Alibaba, which is already low. What is low can go lower. It has fallen, right now trading at $92. These are new lows going down further and further more with no end in sight. It could go 40, 50, 60, we don't know. Alibaba is dropping like that, down 8% last night, and then down another 10% in Hong Kong. Wait up. The index of China, which is represented by KWeb, has fallen more than 10% last night in just a single day. It's now trading at 26. So we are seeing Chinese stocks beyond any point of reversal. It's like perhaps just a dying country, or rather a nation beheld by an autocrat. An authoritarian dictator. So with that, the world is just falling down to maybe 5-year lows for some companies, or some companies an unrecoverable 20-year low. So let's take a look at each one of them. Baidu basically giving up everything, and my sense is that I wouldn't be amazed if this goes below $100 or $90, back to those COVID lows, or even worse. I mean, it's not as if like Baidu is significantly better than Alibaba in terms of cash flows. We think that there will be more sell-offs for these types of names. Baidu remains to be shorted by the market. In fact, you could see that the market is actually sending a signal that every Chinese company is going down. Baidu looking to fall furthermore. All the Chinese cars have been on a steep downtrend, and it remains to be seen whether NIO goes to about $5 or $3. We don't see any support here. XPEV looking to go to the teen levels, just going down and down, could go to new lows, if I may add. I wouldn't bottom pick here. It looks like another 30-40% downside. Any rallies of Chinese shares are seen to go down. We've seen how intervention has happened in China, which has meant that Hong Kong has become the new Ukraine. The world sees Hong Kong, Taiwan as a potential threat, another Russia-Ukraine type number 2. And you can see that all the outflows in Hang Seng Index, these are basically, people are basically seeing Chinese stocks as global pariahs as well. So it's just continually selling off. 20,000, that is the recent low was about 18,000 here, February 2016. I wouldn't be surprised if Hong Kong break that 18,000 and then go to the brinks of, I don't know, 10,000. So I'm not here to predict. Let's just go through what the charts are looking at, and the charts are just sharing downside and just complete drops. Yeah, so, and what about the entire basically the entire Hong Kong is just doomed. All of your technology names. Meituan continues to be falling down. So could we see this at $70, 50% lower from Meituan's 135? I agree that it could. I mean, we've seen how the world already is already bearish in Hong Kong without any liquidity, and with people afraid that there will be sanctions. Right now, the sanctions are in Russia. What happens if an all-out war between Russia, China, and the world happens? Then it's just complete chaos. So the next support of Meituan is as low as 120 and then 70. So it's just really like a complete downhill further. So there's just lower stock prices for Chinese shares. And you're going to see KWeb, yun nga, as I see, there's just no respite here. Any rallies would be seen just further new lows. And that spells the same thing for all Chinese companies, large cap, mid cap, small cap. All the Chinese companies are just being sold en masse. Let's talk further about charts here. Furthermore, we're seeing commodities becoming the only safe haven, if there is such a thing. United States Steel broke very strong resistances at 28, now trading at 33. That means if steel prices are higher, nickel prices are higher, the entire world is facing very expensive houses in the future. Houses and cars are needed via steel. In fact, all of your solar is also needing a lot of steel. Solar and wind infrastructure, all of your buildings need steel. So with expensive steel, say hello to further and further inflation. Let's just take a look at the copper, the top 20 mines in the world. Chile, Mexico, US, Peru, Russia. So Peru, Indonesia, Chile. So you're seeing that copper, which is needed in all of your semiconductors. North, South, Central America collectively host 15 to 20 largest copper mines. Looking at the copper prices, we think that it's still on the way up. So expensive. And this is a clear breakout at 461. And the problem is that it could go as high as $5.50 or $6 for copper. That spells a huge problem on the semiconductors. Your phones, iPhones, your computers are in trouble. That means your Apple, your Xiaomi would have Samsung would have some problems as the months go by. Of course, even shipments are expensive as oil prices continue to be high. So we think that Apple, which has been considered a safe haven, is not really safe. And Apple is going to go down like all the rest of the world. And with Apple going down, we view that Berkshire Hathaway, which has still been trading at near highs, is susceptible to 20% drops if 10% or 20%. And if you were looking to short, you have a very excellent risk-reward ratio on Berkshire Hathaway, as most of the positions on Berkshire Hathaway are looking to be selling off at least 20%. Apple looks to go down. There are supply chain problems. And take note, Apple left Russia, and Russia is, of course, at least 5% of their sales. We would see a conflict, further conflict would be very much detrimental for Coca-Cola. Coca-Cola has also become a significant problem on the input cost. With your sugar, sugar has been rising, so Coca-Cola sales would decline. We think that there is a likelihood that Coca-Cola and Apple could cut their dividends, and you know what's going to happen when there's a dividend cut. It's going to go down 10% or more. So we see a huge position to short Coca-Cola. We see a huge reason to short Berkshire Hathaway, as we don't think the market is pricing in a recession on these companies yet. That's why we expect lower stock prices for them. Okay, so S&P 500, this chart is coming from Ed Yardeni Research. So he shared like the 20 years worth of PE ratios for the S&P 500 indices. So you are seeing the indices still trading very high, here at about 20 times multiple, because it is inflated by your FANGs. We think that most of your large caps today are dominated by Apple, Microsoft, Amazon, Google, Tesla. They have really inflated your market to the point that it could remain high. However, as we think, these things haven't even gone to the median of 16. So even if it was just trading at 16 times, that means at least 20% downside for your S&P 500 for your large caps. So we would say large caps like NVIDIA, that is susceptible for a drop. That's why we are semiconductor shorts still. So we're looking at NVIDIA to drop another 10 to 20% from 230 area. Any rallies to 250, we would consider still a short. So we are shorting NVIDIA since $300, and we will continue to remain short as we foresee it can go 20% lower from 250 to about 200 or 190 or 180. So we view it constructively. We know that the world relies a lot on semiconductors for the phones, for the telecommunications like 5G, and especially all of these electric vehicles would need some connection. However, while I'm not that bearish to see NVIDIA go $100, obviously if it goes there, it's like a chance of a lifetime, if you will ask me. However, do I see another 20% downside? The answer is yes. So continue to remain short on these large caps like NVIDIA, continue to remain short on the likes of Apple through Berkshire Hathaway. Continue to think that S&P, which is SPX, that SPX would continue to fall. So this is S&P 500. So we think that another 10 to 20% is susceptible for a fall. So from 4.2, we do expect another 500 slide. So we're looking at another 5%, a 10% slide. So we do think that you have leeway to fall down. Is it likely that you'd fall here at about 3.3 or 3.4? Or is it here at about 3.7, 3.6? So either way, the trends are showing you very clearly there is still leeway to short the market. You can still short S&P 500 if you are afraid to short. We believe that the risk remains on the downside. I mean, the risk reward, it's still very favorable to short the market. With all the looming risks out there, if you are afraid to go to cash, we think that saving your money to cash is still going to result to a 25% discount. You're still going to get a good discount in the market. So S&P 500 has leeway to fall here at about 4.2, 4.5. It remains to be a good short. So we would view it as a good short area. Any rallies on S&P 500. The mid caps are already at the mean. So we're seeing the large caps, i.e. the FANGs, are still very inflated. The semiconductors are still very inflated. The mid caps are, however, are already in the mean side. So to make it become irresistible, your mid caps, which is dominated by your mid caps would be represented like your Square. I'm not sure if PayPal is a mid cap, but I would assume that yes, PayPal would be in the mid cap region. Visa and MasterCard are more in the large cap already. Roku would be falling here on the mid cap. Netflix is more in the large cap. Large cap is defined by any company trading above 100 billion. So when we talk about above 100 billion, we're talking about the likes of Netflix. Netflix is still, it means that there's still downside on a Netflix. If you're looking to buy a Netflix or a Tesla, I do believe that there is still significant downside. Now for the mid caps, these are mostly the growth companies like the Roku. While it is already low from a historical median standpoint, they're already trading at 14 times as a whole, the S&P 400 mid caps. There is still leeway to fall. So if you're looking to buy some mid cap growth companies like Zoom Video, for instance, I think you can get in at about 20% further lower. So you want to wait in cash for that opportunity. In March 2020 pandemic, you got actually that 12 times below area. So that means that you can buy Shopify maybe 20% lower. So if you're looking, just like I am, I'm looking to buy C Limited. C Limited and Shopify falls in the mid-cap region. They're not the large cap tech yet, but I do believe that they are going to be in the future. So my preference is to wait at these levels. So if you just view 14 versus 12, that would mean another 20% downside. Should you wait for that 20% downside? My answer is a yes. So even those people who don't want the short, I would just caution you on your buying zone on your Shopify. If you think $550, this is irresistible, Nikki. $103 on Zoom, this is irresistible. I suggest you slash off 20% down on that. And that's your irresistible price if you want. So 550 minus 20%, that would be around 450. If you find Netflix 350 irresistible, minus 60, that would be 290, 280. So it is, of course, not a perfect art. There is no perfect science here. But I would suggest anyone who wants to buy the S&P 500 or the S&P 400 mid caps to wait. Waiting would result to about 20% cheaper prices, I think. So wait. If you want to say to yourself, how I wish to have bought the companies like Tesla at the 2020 pandemic lows. For Tesla, I don't think you'll get it at 2020 pandemic lows. However, is it likely that you could buy it maybe 20% cheaper from 850? Maybe yes. Maybe you can buy it at 700. Maybe you could get it at 600. I am not sure, but there is a very high chance that it will. The probability of you giving yourself 3 months time or 6 months time to wait is going to result to 20% discount. So why not? We're not in a hurry, basically. Now, the small caps are actually very much, it depends on how small cap you are buying the small caps. The small caps are already trading very low, but it is not below the COVID lows. So we were actually able to get small caps lower during the pandemic when there was no sign of recovery. So what are these small caps that you might take a look at? The world is thinking that, small caps would be dominated, in my view, with a lot of venture capital names. So small caps would be the likes of, if you ask me, as the SPACs. So there are a lot of SPACs that have been demolished, 95% down. There have been companies that, in my view, are possibly going to be a good company overall. So recently, we've seen vertical farming becoming well-loved yet again. App Harvest is starting to become bought again. Grow Generation, which is, in my view, considered a small cap, is becoming loved yet again at $7. We are seeing some buyers happen in the likes of Agrify, which is also vertical farming. So I'm seeing some small caps in the vertical farming region get slowly bought out. In the small cap region, I have been seeing people trying to be bullish on renewable energy for the same reason that we are in an oil crisis. However, I would caution that these renewable energies are not yet profitable. So in my view, they will trade in a range. But indeed, we saw the likes of CleanSpark go up, the likes of RC Moto go up, the likes of Fuel Cell, F Cell go up, Plug Power go up. So they would fall in the small cap region. And in the small cap region, I think that the sector that will remain in play for the rest of the year would be solars. Nuclears have been, some small cap nuclears are going all-time high, like UU, Energy Fuels. So as a whole, even in the small cap region, even if they're very cheap, cheap is not the reason to buy. You just have to find yourself an earnings outlook that will become better off over the next few months or the next few years, even as the market is fighting off a very super cycle commodity boom. So I haven't checked which small cap in the miners are really gonna benefit, but obviously there will be very small oil miners that will get 10x moves. There will be small companies in the gold miners that will be 10x moves, palladium, platinum, wheat, basically commodity companies, agricultural companies, in my view. All the small companies there would, in my view, hit 5 to 10x their levels, especially if they are really getting a huge boom in this super commodity cycle. So in the small cap region, it would serve us well to find the super small steel miners, the super small copper miners. The smaller they are, the more the bang of the buck. So we're not talking about the Freeport McMorans or the Barrick Golds, because those are already well-known gold miners. But I think there will be very small miners in this group that would deliver the goods. So it's not going to be the ExxonMobil or Chevron that will give you 10x moves. It would be the likes of, I remember telling the Awesome 10x team, Oceaneering, Este, Bry. Let me show to you what these moves have become. These are very small oil companies that are actually registering 10x moves simply because obviously they are delivering the goods on an oil demand rich place. No, so was it a real 10x? $2 to $17 now for OII could hit $20, which is a 10x move. So that is really gonna still be bought OII on dips. These are small companies that nobody would pay attention for, except for an oil crisis like we are in. So Oceaneering delivering the goods, Earthstone, Este, Earthstone Energy. These companies are hitting 10x moves in my view. So $2.50. It's now trading at 13. Can it hit $25 within the year? I'd say the trend remains your friend in a sordid way. That means that, yes, I believe that all is going to hit higher. And therefore, Earthstone is going to go higher. So if you're looking for 10x commodity plays, I would still say that oil is still a commodity that would go higher. And therefore, all of these companies will go higher. OII, Este, they would remain in play, possibly 10x moves from their lows. Buray, Berry Petroleum, Berry Corporation. These are oil drillers. Yes, very small company. They're not the Chevron and the ExxonMobil. So here at about $3, $2.50, we assumed the March 2020 lows was the bottom. And you've just seen that reopening demand. But now it's spiking not because of reopening, but because of this oil crisis. So from about $3, can it hit $25, $30? Your guess is as good as mine. But my guess is that, yes, it may go well beyond our imagination. It will go, what, $200 oil? I don't know. And what type of bonanza would these companies make? Possibly the best money that they've ever seen over the span of 5 to 10 years. So I repeat, for those who want commodity plays, for small caps, you focus on the likes of OII, Este, Bry for oil. I still have yet to know exactly which are the small wheat companies of the world. So I need to research about that. But for the wheat in general, because of this Ukraine crisis, Russia-Ukraine crisis, we've seen wheat go up initially from about $5 to $8 and made a wrecking high towards $12, $13. I do think that wheat will continue higher to about 15 or even worse at $20, exacerbating all the supply problems of the world. There's not much supply. We know that Russia, Ukraine are the bread baskets of Europe. It will impact heavily negative towards your Nestle, towards your companies like, the largest suppliers of wheat. Oh, it trickles on for your staples. So anything like your biscuits need wheat, your bread, your pasta, your noodles. So a lot of these companies, large scale, Conagra Foods would get hit. A large portion of your consumer staples as a company. That's why XLP is, in my view, a big short. So we have begun shorting XLP, consumer staples, and we continue to believe that it will remain so, that any rallies would not defy our thesis that it's over for the staples. It's over for the world. Unfortunately, you will not see food prices become this low. It will just go up every week or every month, and the world suffers as a consequence. So we see consumer staples, which are essentials, gonna be twofold. Rising costs means that there will be margin pressure overall for all the entire food groups that will trickle on to restaurants, So every chain in command goes up. And when commodity prices go up, oil and food in general, the household wages don't go up as fast, the spending will go down and you spell recession. That's why we are pricing in recession in our portfolios. Your portfolio should express the future. And if the future is a world in a recession, it should remain short. That is a world that you should expect. And you should show it in your portfolio. Okay, so well, this is a long in case of course this is a small cap oil. What does it have to do with the big cap oil? Well, the big cap oil we believe will continue to go higher, and we have just seen ExxonMobil going up, and all of these Chevron. The world has been going long oil through the funds like Energy U and XLE. Energy U is the oil commodity fund of all the big oil. When it says big oil, it means it's long ExxonMobil, Chevron. I think like the entire trillions of dollars of the world, the biggest hedge funds, they are short the entire market and they are going long oil through several ways like this one, Energy U. Energy U is up already from $165 to $400. So that's double their money in just 3 months. Sure, there will be some profit taking here and there. I would agree that, some people who went long oil $60 or $40 or $80, some of them are cashing out at 105, 110. They're cashing it out. Some might hold on and wait for further spikes. Either way, this was brought about by reopening demand initially, but nowadays, this is all geopolitical. And since we don't see any of the world's geopolitics getting better anytime soon, and any ceasefire talks is just going to be a reason for people to buy the dips on commodities, we are still going to be of the view that if you want to go long oil, there are several ways. Energy U is one, OII, Estebrai are also the same, and it remains really your friend. That means that oil remains on the upside, inflation remains to the upside. There's no way out of it. So wheat is also no way out of it. You can't just produce wheat unless people substitute their bread and pasta and noodles with rice. Philippines is a rice-eating country. That would be okay. But Philippines also loves their pandesal. And there's a lot of countries like Egypt, Tunisia, a lot are relying on Russia and Ukraine for their daily overall wheat to their breads for their breakfast, for their noodles. So unfortunately, since I don't see demand really going down, that means with supply crisis, there will be higher and higher wheat. If you want to eat your spaghetti, you pay high. That's what's going to happen. So wheat would remain high in my view. This $8 breakout is going to be sustained. Any drops of wheat at 10 or 9 are all buying areas before it goes back to 11, 12. And unfortunately, you can even go break $13 to hit $15 towards another all-time high move on wheat. And as commodities go all-time high, I view that the S&P 500 will become going down and down and down. So there is a way for you to make money here. And it's very clear. You go long commodities and go short the market. Gold remains also a place of safe havens, and we've seen that happen. This is a clear breakout of the last 3 years at $1960. Hitting 2060, yes, that would be fast. A fast move is prone to a profit-taking correction, and that's what you're seeing here. This is simply a profit-taking correction. This is a very strong momentum move from about 1800 to 1840. It had been a long congestion. And what the charts will tell you is that when you have a very long consolidation, accumulation, congestion, once it breaks out, that trend remains up and up and up. How high can gold go? Perhaps 2.2 and then 2.4. So with a 20% increase in gold, a perhaps 20% decline in S&P 500, one of the biggest trades in my view that's happening worldwide, they are shorting the S&P 500 and the NASDAQ, the big money here, the billions and the hundreds of billions of dollars, and they're really parking in towards gold. They're parking in towards the USD as well. So some people are just basically stuck in cash. And I think that those who are waiting in cash are going to buy the markets back. If it's trading at that 12 times PE ratio for the S&P 500, so they'll wait. Basically, they'll buy Apple again, but 20% lower. They'll buy Google again. They'll buy Amazon again. They'll buy all of those large big tech again, like NVIDIA, but 20% lower. That's my thesis and analysis here. So self-driving cars are going to be sold down, in my view, as there will be less and less demand with rising prices. So the consumers will be unable to buy a car, or not affordable, basically. If a family in the US will only have $100,000 a year, they would prefer not to spend it away. So there will be less consumer spending, and auto industry will have that demand possibly fall with a rising price. So this has been a breakdown, and it will just, in my view, continue to fall, just like consumer discretionary. So all the luxury items, specifically Capri Holdings, is going to fall. That's why Capri and Farfetch have already been a strong decline, just like Louis Vuitton. This has been in a precipitous decline. This is a luxury segment, Capri Holdings. Capri owns Jimmy Choo, Versace, and Michael Kors, the bags. I view this negatively. So any rally of Capri will continue to be a sell. So it's very clear that there are very much leeway for you to see a 25% sell-off. So some people would do it via put option. So how do you do a put option here? There's a very clear sell-off at 50-55. So you would short Capri to see it tank 40-50% lower. So I am not kidding in my bearish view. I've been bearish for a long time now on well, I'm not sure if you're bearish. Well, I've been very bearish in November because I was still trying to find a leeway to buy the market, because, you know, the FANGs were going up, the NVIDIAs were going up. There seems to be a reason, you know, like to buy the market. But November, December, January, February, March, there's just no reason to be bullish in the market. All of our profits just came from just shorting this market. And for March, this entire month of March is just going to be a short for me. Maybe April would be another short market for me. Capri, no reason to be bullish. Consumer spending and luxury items, in my view, is going to go down. What? With all the oligarchs of Russia not able to buy their Jimmy Choos anymore, or not anymore able to buy their Mercedes-Benz, or their yachts getting freezed? Well, I believe that all that demand is going to go down, and it's not just going to affect the mass market, but also the luxury market. So Capri is a sell. Louis Vuitton, which is of course Europe's finest, is also, in my view, already showing signs of bearishness. So Louis Vuitton just broke down a very significant support here at 620. And usually, as a chartist, when a significant support gets broken down, the trend remains your friend on the downside. Any rally of Louis Vuitton here at 620, in my view, is a short. So it's a short. Can it go down to 360? It could. I'm not sure. I mean, possibly not, because this is a large cap. But can I sell 600 to make money on the 520 or 550? My answer is yes. So Louis Vuitton is also a short, in my view. There's a ton of what's this? There's just too many companies that you could short. Let's put it here. CPRI short 50, 55. Louis Vuitton, short 600. Well, Louis Vuitton is in Europe, so even more. Euros, even more recent, the short. Euros have been declining very fast. So they are getting hit on their currencies. So US energy consumption, this is a fact by Energy Information Administration. I don't know if this statistics is really correct, but the point is that the world is running 80% on fossil fuels and 10% renewables, nuclear 8%. Now, even if we double or triple or quadruple or 10x the investment over solars, we can't just go electric overnight. And so that means that your oil crisis will persist for another 1 to 2 to 3 years. And that means that with a longer term time frame of inflation, your position or your overall allocation towards fossil fuels can be met via a long oil play. So that still is long oil, long the energy use on dips. You want to go long those OIIs, Este, and Bri on dips. So even if they're already high, I do believe they'll go higher. Of course, I mentioned that there are companies that do not reflect that recession yet in the stock price. So we still view a very good risk reward to short Berkshire Hathaway at 3 to 5 because we see demand slowing down for Apple, Coca-Cola. We think the Bank of America would have significant exposures or companies that will have little or small leeway ties with Russia and Europe, which will have a downtrend. So we think that Berkshire is trading at a premium versus the composition, hence it is a short. So this Berkshire Hathaway is still trading near all-time highs. With S&P 500 looking to fall, Apple looking to fall, we don't think Berkshire Hathaway stays afloat here at 325. There will be a big drop here. Citigroup is also a bank that in the US that has $10 billion of exposure towards Russia, which we think is going to be written off in their earnings call. So we think that they will decide to take a loss on it. I mean, who's going to buy it anyway? So that means that Citigroup will face a lot of losses, and we expect any rallies towards $60 or 65 to still be a sell for Citigroup. So this is a news clip that just released today, seen CNN. Russia owes the Western banks $120 billion. They will not get it back. Citigroup is one of the largest loaners on Russia. They will not get it back. Let's just read this. Goldman Sachs has been going away from Russia following the invasion of Ukraine. Most are also likely to follow at a cost of $10 billion. So that means they're cutting their ties on Russia, and that is a huge loss on them. Says here that international banks today have loans owing more than 121 billion by Russian entities. It is probably unreclaimable. In fact, I think World Bank already said that Russia is going to be a default country and they'll likely default on everything that they owe. So France, Italy, Austria, the most exposed. So Europe is basically out of whack. They have $84 billion owed to them. So yun, patay yun, that's gone. By the way, that means that we are very bearish on European financials because of that too. So we are remaining short on Europe. Following this, Fitch Ratings said that the large Western European banks' asset quality is facing increasing risk in order to comply with international sanctions. Societe Generale has more than enough buffer, that's what they say, but they are, of course, going to lose what, 20 billion. France, BNP Paribas has a $3 billion exposure to Russia and Ukraine. UniCredit said that they've got $7 billion of loans, so that's gone. Credit Suisse, $1 billion Swiss francs. Deutsche Bank said they've got loan exposure of $1.5 billion. Citigroup has 10 billion, so we're seeing something like a Lehman Bear Stearns event here. Mark Mayesan, different stress type of scenarios. Russia is important in terms of energy markets. We don't know how big exactly, but we will know that upon earnings call. So the market has already priced in negatively all the European financials. And we chose EUFN, which is the MSCI fund that's shorting all the European banks, from the Societe Generale to the Deutsche Bank to the Credit Suisse, UBS, BNP Paribas. So all of them are shorts. Any rallies here from 17 to 18 or 20, we would view it as more conviction to just short further. So we believe that the fundamentals have deteriorated, whether it goes 12 or 10 or new lows. We do not know the low, but we believe that the trend is on the downside. And there are questions that are left to be answered, which will only be known only on earnings call. So for EUFN, we are a short. We believe that US banks are getting hit. Therefore, we are also short XLF. So XLF, we've been shorting 38. So we think any views, 37, 38, these are all shorts. You can still continue doing your put options on XLF. XLF is significantly your Bank of Americas, your JP Morgans, your Citigroups. This is one of the reasons why we're bearish Berkshire Hathaway, as we believe Berkshire Hathaway is 25% owner of banks, US banks. So American banks are not going to be safe here. And so Berkshire is a short, XLF is a short. And that means that the financial bear, which is FAS, continues to be a long. So we are long on FAS since 16. We continue to go long at 20, 21. Even if it goes down to 20 below, we believe that it's still a long. As we foresee, there is a huge disconnect right now between the markets pricing in a recession and potential defaults versus what the stock price is saying. There is some aberration that you can continue to make an opportunity here by shorting the US financials, by shorting European financials, or by going long FAS. Okay, it's been a long topic, but we are, yeah. So just to end, let me just go through some of the solutions that the market is looking at. Although I think these longs might not be sustainable. So far, there has been a strong interest in agricultural science stocks. AgriForce, AppHarvest have been rising. I'm not quite familiar on Arcadia or Yield 10 or China Green or Vivacor. It could have been just a short squeeze pop. It could have been a pump and dump. But for AppHarvest, which is a SPAC, we do think that the $3 has become support, utilizing and quadrupling their farms. After earnings, AppHarvest has just been almost doubling from 3 today. It's about 5.30. If it hits $6, that's almost 100% increase in just a few days. So this is AppHarvest. Think that the market is pricing in necessity for food security. So any prices below 4 would be met with buyers on AppHarvest. Perhaps it could be a short-term thing, but it's worth something to look at. Same thing for Agrify. We're seeing some bottoms here at $5. Same for Grow Generation here about $7. Looks to be getting some buyers. Agriculture producers, this means your John Deere. All of them are looking to go higher as the world is really very much afraid of food security. So all the agricultural producers are getting bought up. Deere Company is getting bought on dips. You can see that. We are bullish on Deere Company. We are also bullish on Caterpillar, which is what the farmers need to till the land. We think that tractor supply will continue to go higher, just like what oil prices have been doing. So TSCO. Mosaic has been going all-time high, the fertilizers. Basically, people are willing to buy up fertilizers for the plants. So being a farmer is a very good thing in this world today. Or selling farmer produce, or selling the farmer fertilizers, the inputs to produce the goods. CF Industries, which is nutrients as well, fertilizers going up, all-time high, as you can see. We do not disagree with this all-time high move, as we don't see agriculture going down. Non-stop fertilizers, vertical rise. Nutrien has gone 76 to 105. Agricultural funds are going up. So this is DBA. We view this positively, still going to go up. Commodities, any dips have been a buying zone. Coal prices, just like oil, is 80% running the world. So been trading all-time highs further. Gold trading all-time highs. Any drops would be a buying zone. If you want to go long, $180 would be a great area. Although I'm not sure if you can get it at 180. It might be very much a lot of buyers even at 184. And that would be it. Okay, so that would be it. These are just large caps that I believe there's still further downside. So Netflix can still go down to about 300 or 250. Roku can still fall from 110 to about 90. Although the recent low, pandemic low was $60. So yeah, that would be it. And see you again next week. And I hope you learned something. You know how to position your portfolios. And have a good day. Bye.